What's up, guys? I'm Nobody Special, and today we finally got the announcement of the long-awaited taper. All right, the Fed is finally going to taper their asset purchases. We've been waiting all year for this. We've been speculating about whether or not they were going to do this. They finally made the announcement today. They are going to begin tapering their asset purchases this month. So real quick, I want to talk about what that means and why some people think this is a big deal. Okay, first of all, some context. Ever since the pandemic hit, the Federal Reserve has been doing basically quantitative easing, or some have called it QE infinity, where they have been printing at least $120 billion of new currency every month. And then with that money, they have been buying treasury bonds and mortgage-backed securities, mortgage bonds, those types of things. So the reason why they've been doing that is, number one, they've been trying to inject capital into the systems to make sure banks still have money available for lending, which banks really haven't lent the money out. Basically, they've just parked it right back at the Federal Reserve in the form of their reverse repo program. The other reason they've done that is to keep interest rates on those bonds and those mortgage-backed securities suppressed, and that keeps loans cheap. You see, remember, with bonds, prices and yields are inversely correlated, and yields are basically interest rates, right? So if the Federal Reserve prints money and buys these products, they drive up the price of those products and they drive down the yields or the interest rates on them. So by creating this money out of thin air and using it to buy these financial instruments, they have been holding interest rates down. Okay, that's important. What they've been doing is pushing interest rates down. Now, they've also held interest rates at essentially zero at the same time. So what the Federal Reserve has been doing is they have been suppressing interest rates. They've been keeping the price of money cheap. Okay, now what they announced today is not the end of that. What they announced today is that they are going to begin slowing that. Okay, they're going to slow it by $15 billion a month, which means last month they printed $120 billion to buy up these bonds. Next month they're going to print $105 billion, and then the month after that 90, the month after that 75, until we get down to net no printing, and that is expected to be in the middle of next year in the summertime. So why is this such a big deal? First of all, this means higher interest rates are coming one way or another, okay? This doesn't mean the Fed is going to raise rates right away, but this does mean that rates are going to start going up. Remember, with the bond yields and the bond prices being inversely correlated, if the biggest buyer of bonds, the Federal Reserve, slows down the rate at which it buys the bonds, i.e. the demand for the bonds goes down, but the supply stays the same, that means the price of the bond is going to go down. And with the price and the yield inversely correlated, that means the interest rate on those bonds is going to start going up. So in effect, what this taper means is that interest rates are going to start going up, even though the Fed isn't actually raising rates just yet. But the net effect of slowing down these asset purchases means less demand for these bonds, which means higher yields. Now, the other thing to keep in mind is the end game here is the Fed plans to, at least on the surface, they plan to eventually raise interest rates. Now, these interest rates, when you hear the Fed funds rate, when you hear the US 10-year note, okay, understand these are the interest rates that all the other interest rates in the economy are based off of. So when the Fed funds rate goes up and when the 10-year Treasury bond goes up, that means credit card rates are going up too. That means car loan rates are going up too. That means mortgage rates are going up too. So we have a debt-based economy, and debt is about to get more expensive. And there's a lot of people saying that this is the signal that a market crash is coming, that a market crash is imminent. And I tend to be in that camp, although I don't think the market crash is going to happen right away. It could. But I think within a year or two, I think we're going to see a major stock market correction. And by major, I mean more than 10 to 20%. I mean major. And I just want to show you a couple of things real quick here. First, take a look at this 10-year chart of interest rates on the US 10-year Treasury bond, okay? And this is going all the way back to the 1960s. Now, you'll see this big spike towards the beginning of the chart. That's Paul Volcker fighting inflation at the end of the 1970s and the early 1980s. Inflation was running rampant in the 1970s. It was a big problem for everybody. And the only way the Federal Reserve could fight that inflation was to jack up those interest rates. And you see how high they went, over 15%. I mean, Paul Volcker was a madman with the interest rates. And he did get the inflation under control. That's important to understand. That did fix the inflation problem, but at a tremendous cost. There was a lot of unemployment because a lot of companies went bankrupt. When the cost of debt became unsustainable for them, those companies went bankrupt. The real estate market was clobbered because mortgages were so expensive, people couldn't afford their homes. All right, so this came at a cost. And the reason why I point that out is because this is where this is all heading, supposedly. This announcement of the taper and the eventual raising of interest rates, this is all being done in the name of fighting inflation. And the last time we fought inflation was the end of the 1970s, and you can see how far they had to take it to really get that inflation under control. And if you look, we have been marching steadily downward year after year ever since. There have been minor ups and downs, but really since 1983, the trend has been down in interest rates to the point now where we are at effectively zero. Rates can't really go much lower. Now, this is important because all throughout this time, the United States, in every facet of our economy, has amassed an enormous mountain of debt. Okay, a mountain of debt so big that we've never seen anything like it before. Now, when we fought inflation in the 1970s, when Paul Volcker raised all those interest rates, we didn't have that big mountain of debt, and it was still extremely painful. We still had unemployment. We still had a bad real estate market. Can you imagine if we had tens of trillions of dollars of debt? What would have happened to the interest expenses on that debt if we had done what Paul Volcker did? And just to put that in perspective, I want to show you a couple of other charts. First of all, here's one you're probably all familiar with. This is U.S. federal government debt, all right? Currently around $28 trillion. We're fighting over the debt ceiling. It's going to get raised. It's going to go to 30 trillion pretty fast after that, right? If you notice, back in the 1980s, when Paul Volcker fought inflation, federal government debt was nothing like it is today. So if we raise interest rates the way Paul Volcker did to fight inflation, the way they're suggesting we're kind of doing here, nobody's talking about taking it as far as Volcker, but just heading down that road, what happens to the interest expense on a debt that big? But it's not just federal debt that has people worried. Take a look at this chart. This is U.S. state and local debts. So you can add another 3.2 or 3.3 trillion to the federal government's debt. This is debt at the state and local level. If we raise interest rates, this debt gets more expensive to service. The interest expense on this debt goes up if we raise interest rates to fight inflation. That money has to come from somewhere. But it's not just public debt that's a problem. Because remember, all interest rates are determined by the Fed funds rate and by U.S. Treasury rates. Take a look at this chart. This is U.S. corporate debt. Companies that have been kept alive by easy access to cheap money in the debt market. Now at $11.2 trillion of corporate debt in the United States. So what happens to this cost? The cost of the interest on this debt when the interest rates start to go up? What happens now when companies that have just been rolling over their debt, refinancing it at cheaper levels so they can keep their cash-losing businesses afloat? What happens when they can no longer refinance at a lower interest rate? Now their cost of doing business is going up. They don't have any income. The company goes belly up. But it's not just corporate debt. It's not just government debt. Take a look at this chart. This is total mortgage debt in the United States. Yeah, this one includes your house. Or if you rent, this includes your landlord's mortgage payment. All-time highs. Again, almost $17.3 trillion in U.S. mortgage debt. So you can add that to the pile. And we haven't even talked about personal loans, car loans, student loans, credit card debt, right? There is a ridiculous mountain of debt, both at the public, at the corporate, and at the individual level in the United States. And all of that debt is about to start getting more expensive. Now, we've never had this much debt before, and interest rates have been heading down, down, down since 1983. So pretty much my whole life, interest rates have been going down. Now we're talking about sending them back up to try to control this inflation problem. Well, what happens to the cost of the interest on all of those debts that I just showed you when the interest rates go up? And this is why some people are saying the announcement of the Fed's taper and the eventual raising of interest rates is going to lead to carnage in the United States. Because we've never simultaneously fought inflation while dealing with a mountain of debt like we have right now. We're about to find out what happens when you do that. And if 2018 was any indicator, in December of 2018, Jerome Powell had 4 times that year raised interest rates to try to normalize the period of near zero interest rates that followed the global financial crisis. And the stock market threw a fit in December of 2018. And Jerome Powell had to very abruptly reverse course and start lowering rates. And he did it at a time when unemployment was very low and things were seemingly going very well in the United States. So that's why everybody's making a big deal out of this taper. And that is one of the main reasons why I have been raising cash for the last month and a half or so, taking profits in stocks wherever I can to try to raise enough cash to have ready to buy assets, because I think if the market does freak out like it did in 2018, and I think that's probably going to happen, then a lot of good assets are going to go on sale along with the bad assets. The baby will be thrown out with the bathwater, and you'll have the opportunity to load up on good investments, good assets at fire sale prices when that happens. Now, let me just CYMIA here and say, folks, I'm not a financial advisor. This isn't financial advice. This is just financial edutainment. I want you to do your own research, your own DD, and arrive at a decision that's right for you based on your unique situation. And I also want to say that I can't say when this is going to happen, okay? There's a famous quote that markets can stay irrational longer than you can stay solvent. So I'm not doing anything like shorting the market or anything like that right now. This could go on. I mean, this stock's making all-time highs, could keep going for another 6 months, for another year, maybe another 2 years before this ticking time bomb of debt and interest rates finally goes off. But I think it's just a matter of time. And my best guess, based on what I saw in 2018 and where I see the debt pile is right now, somewhere between 2% and 3% on the US 10-year Treasury. Somewhere between those two interest rates, the market is going to throw a fit and it's going to sell off big time. And after that, who knows? Is that going to be when the Federal Reserve says, see, we need to turn the printing press back on and QE infinity resumes and the dollar's death spiral happens again? Or as a society, do we finally come to our senses and realize that the era of funny money was a mistake and we need to start living within our means, both as individuals, as companies, as communities, as states, and as a country and as a world? Maybe that's a little pie in the sky. I wouldn't hold your breath on that happening. Anyways, guys, that's all I got for you on this one. I want to thank you for your time, for watching this video. Don't forget, give me a thumbs up, subscribe to my channel, hit that notification bell. It really helps me out, and I'd be forever in your debt. Until next time, live small and dream big.